Hey everyone, this is your September market review. So for those of you that haven't seen these videos before, the reason that I put these videos together each month is to give my clients the straightforward information with no media spin, political angle, or fear tactics that many media outlets use to get more viewers to watch their show. My goal with this is to give the information about what's going on in the stock market and the economy, and then how that affects my clients' money that's invested with me. So for this past month here, stocks were down again in the month of September. September seasonally is a pretty bad month for the stock market. Going back to the end of July, markets had hit a peak at the end of July, up close to about 19, almost 20%. Since then, they've dropped off about 9%-ish. Stock market's still up a little over 10% for the year. That's as of October the 5th when I'm shooting this video. So on a short-term basis, stocks are definitely very oversold at this point. Not that they can't get more oversold, but all the short-term indicators that I follow have the stock market on a very oversold basis. So what that would mean for my clients out there, or for anybody else that's watching, is that now is a good time to invest new money. What I've done over the past month or so here is reinvest some money that was in short-term bonds, putting that into stock positions within the portfolio. For any of you clients that had money that was newly added or had been added over the last handful of months, I put that to work here over the last month and a half, just because of the opportunity that the stock market drop here has given us. So those are some of the positive things that can happen when the stock market does drop like this. Looking at really where we are within a market cycle, this is just another test or an example of how stocks move. Stocks aren't going to be moving in a straight line up. If you're an investor and you've invested any amount of money in the stock market for any period of time, you would know that, obviously, if looking at your account, because of market drops periodically that happen. So an 8%, 9% move down in the market in the course of 2 months is actually pretty normal and really healthy compared to how high the stock market had gotten as quickly as it had gotten into the middle of summer. So not to say it's not going to get back to that, because I think that it will get back to that level that we were at at the end of July. I think that the last quarter of the year, the last few months of the year, are going to be really good for the stock market, just because the economy is still doing really well. The Federal Reserve has slowed the pace of raising interest rates and might not raise interest rates again this year, but that's still kind of on the table. One of the bigger things that has led to the market drop-off here has been interest rates on longer-term bonds going higher, which is actually a healthy sign for the economy, because that means that investors want to be making more yields for these longer-term bonds, whether they be 10-year, 20-year, or 30-year dated bonds, versus the shorter-term bonds had been actually making more interest than those longer-term bonds, and now there's been more of a move or a flattening of what the yield curve is. Because typically a healthy yield curve, and I'll put a chart up of it, would be that short-term bonds are going to end up actually making less interest than longer-term bonds. We've been in an inverted yield curve where shorter-term bonds were actually paying more interest than longer-term bonds. So over the last couple months, that longer-term duration has gotten more interest, or is being paid more interest now than what it was prior. So what that does is it causes a little bit of, obviously, volatility in the stock market, because people may want to be putting money into bonds that yield more money now. But if you're a bond investor, which as a client of mine, the only bonds that you hold would have been short-term bonds, so this doesn't apply to you. But for typical bond investors that have longer-term bonds held within there, this is a terrible thing when interest rates are moving up like that, because that means the price of those bonds are actually moving down, meaning that those investors are losing money even though the rate on new bonds is going higher. So just a couple things going on within the market I wanted to talk more about. Really just keep in mind, the one takeaway that you can get from watching this is that the short-term gyrations that happen within the market, those are normal and healthy. So we're not going through any sort of dramatic changes within the market. This is just another normal pullback that's happening within the market. So I have a few charts this month that dive into the economy and kind of where things are at. The first one I'll go over will help maybe calm some nerves out there from an economic standpoint. This is a chart of the U.S. income versus spending in a dollar amount. So this goes back through 2015 through today. You can see in 2020 there was big drop-offs in consumer spending. That was because of COVID and no one's spending any money, going anywhere, doing anything. We also were making more money because of stimulus checks at that point. So that is, on the blue chart there on the other side of things. This is a healthy thing because if incomes are still continually going higher, and even though inflation over the last couple years has been higher, and I'll have a chart talking about inflation here in a minute, consumer spending is also going up, which is a great sign because that means that people, while they're making more money, they're also spending more money because they feel confident in their paycheck that they're making and are willing to spend that money because they're not worried about getting laid off. So I thought that was a really good chart showing really the state of the economy in one chart there. The next chart is going into inflation, is the consumer price index change, 12-month change going back through 2013. So right now we're just under 4% on the CPI or consumer price index. We were as much as 9% here a little over a year ago. You can see the dramatic drop off. That's because the Federal Reserve has raised interest rates so much. That's what led to that drop off in stocks in 2022. So we're not quite back to the target that the Federal Reserve would like us to be at, which is 2%. But it's a lot lower than where it was. So I talked with a client here yesterday, and he was just mentioning how high inflation is, and he was really just kind of citing things at the grocery store and just everyday common goods and stuff that he has to buy. And I explained to him, I was like, well, while inflation is actually lower, because you can see here in this chart, it is lower, it doesn't mean that prices on things are going to dramatically drop off. There's a few instances of prices readjusting back to that, but overall, prices are going to stay on all goods, are generally speaking staying higher. What you don't want to have happen is not inflation, but disinflation, where prices end up going down. That's actually a terrible thing for the economy, and would be a sign for sure that we're in a recession if things were dramatically dropping in that way. And instead of this CPI number being at just about 4%, a time frame that we were short-term, about 0 or below was 2015, and that was actually a very bad time frame for not just the economy but stocks as a whole, and was a spot where there was concern that we were going into a recession again at that point. So just something that just that I hear out there, I wanted to share with you all, and also just kind of going through inflation. One of the charts kind of tying into inflation a little bit here, kind of piggybacking on my client that was talking about grocery prices. So this was a chart that I was kind of referencing to him, and I thought it would be valuable for the rest of you to take a look at. So going back through 2018, you can see the price of a gallon of whole milk versus the price of a dozen grade A eggs. The grade A eggs have round tripped. They're right back at about $2 of where they were about 5-6 years ago. And while whole milk, on the other hand, was at $3, is now close to $4. So that hasn't come down too dramatically, and was not as dramatic of an increase as the way that eggs were. So that's just the one example of how inflation can work. And a couple of the things within here that I pointed out to him about egg prices was that while egg prices did dramatically move higher, they've come down dramatically, because one of the reasons they went up as much as they did was because of supply chain shortages a little over a year and a half ago at this point, and that's what caused prices to dramatically move higher to where they were at close to $5 for a dozen eggs, and they've dramatically come down because now there's an oversupply. So just the way that the economy works of supply and demand at times. But I thought that was an interesting chart because anybody that's buying eggs or milk out there or any other groceries feels that pain of inflation. And while we'd like prices to go back to where they were before, because if we're making more money or just making the same amount of money we were prior, that would feel a lot better, but that's just not the reality. And you really don't want that to be reality either, because that would be a bad sign for the economy and a bad sign for your portfolio, because stocks would drop off because of that likely. Last chart that I have here was a chart of the average rate for a 30-year fixed mortgage. I thought this was a good chart to reference just because I know a lot of you that own your home or still maybe have a mortgage on your home are in the lucky camp of having that 3 or maybe 4% rate on their mortgage. Currently rates are at about 7.5%. Some rates are closer to 8% depending on where you're looking and credit rating and all those types of things. But I like this chart because it shows the historical levels of interest rates. So for those of you that bought houses back in the 80s or even early 90s, you can remember double-digit interest rates on your mortgage. And at the peak in 1982, we were at 18-19%. So obviously that's an extreme example. Typically the average mortgage rate is closer to that 6.5% to 7.5% range, which we're at the higher end of that range right now. So while it feels painful if you're a new homeowner or somebody that's had to buy a mortgage here over the last, or get a mortgage here over the last year, it's painful in relative timing. It's not that dramatic if you look historically at it. And really, if you're a new homeowner or somebody that's bought a house and had to get a mortgage, one of the benefits of rates being higher is that when rates went higher, what it did is it slowed the increase of housing prices. So because of rates being higher, even though you're paying more on your monthly payment, you didn't have to pay more to buy the house. So as rates hopefully eventually go down, you can refinance that. So I thought that was an interesting chart, just kind of showing the historical level of mortgage rates, especially for those of you. I know a lot of my clients are in that range where they bought houses when they're in the 1980s. So I thought that would be a fun chart for you all to take a look at. So if you have any questions, don't hesitate to call, text, or email me. If you have friends, family members, or anybody that you think would be interested in having a conversation with me or benefit from having a conversation with me about their investments, please get them in touch with me. Either get me their info and I can reach out to them, or just give them my cell phone number, and I'd be more than happy to connect with them that way when they reach out. I am not doing in-person reviews this month. I'll be back for those of you in the Pennsylvania area, I'll be back up there the week after Thanksgiving and the first week there in December. So I'll be linking up and reaching out to you here probably end of this month, beginning of next month, to schedule those reviews. So just stay tuned for that. If any of you would like to do a Zoom meeting between now and then, I'm more than happy to do that and connect with you all that way. So I appreciate you all taking the time to check me out. Until next time.